Hello and very warm welcome to the platform of Victory IAS. So as you are aware that we are discussing the rapid revision series for current affairs for last 2-3 years, which are important with respect to the prelims 2026 UPSC prelims examination. So on that regard, let's start a new topic related to investment and insurance, right? So we will be discussing the topics or the current updates related to investment and insurance, right? So when we talk about investment, capital market is one sector where Securities Exchange Board of India is the regulator, SEBI is the regulator, and among them, commodity market is one of the one part related to investments. So we can talk why it was in news. So this is one context behind it, that SEBI has taken action against 5 commodity brokers. Now, what is commodity market? That we need to understand first. So when we talk about commodity market, first, commodity broker. Who is commodity broker? So it is a firm or an individual who executes order to buy or sell commodity contracts on behalf of clients. So clients are buying commodities, maybe they buy in future, maybe the rates of those commodities are taken as derivatives, so entire derivative market is there. And a commodity market is a marketplace for buying, selling and trading raw materials or primary products, right? For example, if we talk about commodity contracts, they include futures, options and similar financial, for example forward also, right? Forward, future, options, similar, swap also, similar financial derivatives, right? The prices are derived on the basis of the price of these commodities. After the merger of Forward Market Commission with SEBI, this Forward Market Commission was to look after these forward market. With SEBI, this SEBI has been regulating the commodity market, right? So now the regulator of commodity market is SEBI only. As we have seen, SEBI was established as a statutory body in 1992, but we see it was established at statutory body in 1992, but it was established in 1988 as a body under Ministry of Finance, right? Now in 1992, what happened? SEBI Act was passed and it was given it was given the status of a statutory body, right? So to protect the interest of investor and to promote and regulate the securities market. That is what we can understand. We have seen earlier in detail what are the functions of SEBI, how it got established, etc. Investor risk reduction access platform. Now the idea of SEBI here is to protect the interest of investor, right? To protect the interest of investors, stock exchange have been directed by the Securities and Exchange Board of India to set up an investor risk reduction access platform, IRRA platform. With the growing reliance on technology in the securities market, there is an increase in instances of glitches in trading member system, right? So maybe the systems are having some glitch, and because everything in stock market now happening online, so for those systems, some of which resulted in the disruptions of trading services as well. In these cases, investors with open positions are at risk of the non-availability of avenues to close their position, especially at the time of markets, when the markets are volatile in nature. So when you are transacting and you are facing some issues, so risk reduction action platform will be jointly developed by the stock exchange to enable investor to square off their position or to cancel the spending orders if there is a disruption of services provided by the trading members. Now trading members are those who trade online on their own account as well as on the account of their clients. According to new circular of SEBI, the trading members can request the enablement of IRRA service in case they face technical glitches that can cause disruption in the trading services, right? The market regulator, that is SEBI, has directed the stock exchange to monitor parameters like connectivity, social media post, order flow and others. It also called the stock exchange to initiate the enablement of the service if required, irrespective of the trading members request. Now the SEBI has also called on the stock exchange to put in place a detailed framework to support the reverse migration from IRRA system to the trading members trading system when the trading system is revived and request is made in this particular regard. So this is related to SEBI. The stock exchange are also required to periodically test IRRA platform from time to time for the seamless functioning of the service. The SEBI has asked stock exchange and clearing corporations to operationalize IRRA platform by October 1st, 2023. Now insurance law. Now we are discussing the topic related to insurance. Insurance law review on cards to push for efficient use of resources. As we are aware, efficient utilization of resources and all is important for attainment of potential that is there in the sector. In light of changing needs of insurance sector, a comprehensive review of sector's legislative framework has been conducted by the government in collaboration with the Insurance Regulatory and Development Authority of India, IRDAI. So IRDAI is the nodal body with respect to the implementation of programs and schemes and statutes related to insurance and the industry. Now, what is the background? So, the Department of Financial Services, that which is under Ministry of Finance, is in the process of amending the Insurance Act 1938 and the IRDA Act 1999 to take the reform agenda in the insurance segment to the next level. Now, this insurance regulatory framework, as you can see in India, this IRDAI is a statutory body, means established by an act, established under IRDA Act 1999 for overall supervision and development of the insurance sector in India. So supervisory body and development also is there. Promotion of competition as to enhance the customer satisfaction, because when there are more competitors, more service providers, there is no monopoly, and then we can have better services given by those suppliers, right? Ensuring the financial security of the insurance market. The Insurance Act 1938 is the principal act governing the insurance sector in India. It empowers IRDAI to frame regulations for the supervision of the entities operating in the sector. Now, the proposed amendments which are there primarily focus on enhancing the financial security of the policyholder, promoting policyholders' interest, improving returns to the policyholder, and facilitating the entry of more players in the insurance market, leading to economic growth in employment generation as well. So we need more. So earlier we were not having 100% FDI in that. So you may have seen this insurance firms like Tata AIG or ICICI Lombard, right? ICICI Lombard. So why these mergers are there? Because Lombard or AIG, these are foreign institutions, right? And these are domestic. So since 100% FDI was not allowed, so they were having collaboration with domestic firms. But now, since now it is allowed, it has been allowed, so 100% FDI is also allowed. So you may see a standalone new foreign firm also providing insurance services, enhancing efficiencies, operational and finance of the insurance industry, enabling ease of doing business, right? These are the things. Now, what are the reforms suggested by IRDAI? So if we talk about reforms in insurance sector, issuing composite licenses, which is common lines license, banned as of now to operate in both the life and general insurance market. So now government is giving different license for life insurance and other insurance schemes. So that is there. So what reform has been suggested by RDI? That we should go for single license, reducing the minimum capital requirement of 100 crore in order to enable the entry of smaller players, for example micro insurance, to serve niche markets. Now please understand, this insurance business is all about trust, right? It is all about trust. If trust is not there, this business cannot flourish, and insurance is needed for security, right? For example, accidental insurance, etc. So there are many type of insurances, right? And these insurances, people pay premium to it, right? The premium may be very small amount, but when we talk about some insured is a good amount, maybe a hefty amount can be there. So for example, a person is purchasing this life insurance, and maybe the sum insured is about 1 crore or 2 crore. Maybe the premium will be much less than that, maybe 15,000, 20,000, right? So premium amount is very less as compared to the sum insured. Why these businesses flourish? Because they know that everyone will not be in the need of this, will not be availing those sum insured amount, maybe, right? For example, accidental insurance. So you have taken accidental insurance, but you may not encounter any accident in your life, right? So your premium will be accumulated only, and maybe one person is encountering that and they have to pay sum insured. So that is the different story, right? So many numbers, very less percentage of people are also claiming insurance in that regard. So that is what the business is all about. But if one particular insurance firm will default on the sum insured amount that needs to be paid, then what will happen? The trust will erode, and if trust erodes, then maybe this businesses will find very difficult to get the people who can enroll in these businesses, right? So earlier reforms, the government raised the foreign direct investment FDI limit in insurance from 49 to 74% in 2021 budget. The IRDAI approved proposals involving investment solvency norms, dilution of equity and funding, aimed at promoting ease of doing business and simplifying the process of setting up an insurance company. This is one thing that we can understand. Significance of proposed changes: it will facilitate the longer term growth of the industry and bring India closer to the global practices. It will also enable insurers to offer more comprehensive services to the customer, and companies tap into newer market segments and reach new customers also. In the current digital environment where the customer expectations are fast evolving, these changes will provide uniform yet personalized services to the customers. Now, if we talk about insurance regulation, the government has notified 6 insurance regulations decision of IRDAI with the aim to boost insurance penetration. What do we mean by insurance penetration? The number of people who are availing insurance in the country from present around 4% to world average around 6%. Now, what kind of decisions they have taken? So, insurance penetration needs to be increased. Why it needs to be increased? It also offers greater service. It also offers security to the people. It also help people when they are in distress. So these kind of things are also there, and it also earns good interest for the good tax amount for the government also, right? Increase the in tie-up limits for intermediaries. So tie-up limits will be increased for the intermediaries. That is the maximum number of tie-ups of for corporate agents and insurance marketing firms have been increased to enable last mile insurance penetration and increase the choice of insurance as well. Now, the regulatory sandbox time period increased for insurance or intermediaries from 6 months to 36 months. The regulatory sandbox time, if we talk about regulatory sandbox, it is a framework which provides a testing environment to the companies to enable them to test their innovative products, technologies, etc. in a controlled regulatory setting before launching it to the people, right? Before launching it on ground, first they test it. That is known as what? Regulatory sandbox. It promotes innovation and technology solution in the industry. Experience and qualification requirement for the appointment of actuary means it values the reserve of insurance to pay future policy benefits have been made flexible, and registration of insurance companies made simpler to promote ease of doing businesses. If other measures we talk about, then proposed amendments in the two insurance acts, 1938 and IRDA Act, for overhauling the insurance sector have been put for public comment or for the in public domain, right? So that surety bond insurance, for example, this surety bond insurance is a risk transfer tool for the principal. Here government agencies are the principal and shields the principal from the losses that may arise in case of contractor fails to perform their contractual obligation. For example, in infrastructure projects and something like that, if contractors are failed to oblige their obligations, then what will happen? This will be done by surety bonds, right? It has been started for first time in India by Bajaj Allianz. Example, if a government agency, that is NHAI, that is National Highway Authority of India, has awarded a project to some contractor to finish, the contractor leaves midway, then NHAI can recover the losses from the surety bond and award the rest to the work to another contractor, right? For example, why I have said infrastructure or NHAI example is given here, because this infrastructure projects needs more time, right? So time frame is there, and sometimes it becomes very difficult because gestation period is also very high. What do we mean by gestation period? The time where you are doing investment and when you are you start earning profit. So the time gap is very large, known as gestation period. Surety bond insurance product for infrastructure sector. So the Union Ministry of Road Transport and Highways is set to launch India's first ever surety bond insurance product for highway contractors on December 19 this year. This comes 2 years after the Union Ministry directed the insurance regulator IRDAI to explore the feasibility of surety bonds. We have already explained and understood what is surety bond. If government is giving any contract to any particular contractor, and if they are not obliged, if they are not fulfilling their responsibilities, this particular contract can be given to new contractors with the help of surety bonds. The funds can be raised from there. Surety bond is a three-way agreement between the principal, surety, and obligee. Surety means insurance firm, and obligee means the contractor here in our case. The surety is a company that provides a financial guarantee to the obligee, that is usually the government entity in case of infrastructure projects and surety bond, etc. The principal, that is business owner, will fulfill this their obligation. A principal's obligation mean complying with state laws and regulations concerning a specific business license, or maybe meeting terms and of a construction contract, depending on the type of surety bond it is. If the principal fails to comply with the obligation, the obligee can file a claim against the bond to recover any damage or losses incurred. The surety is required to pay repartition or reparation that cannot exceed the bond amount. So it depends on the bond amount, what exactly it is, and this makes surety bond a risk transfer mechanism. So risk has been transferred from government. Earlier government would have incurred losses there, but now this risk has been transferred to the insurance firm. Surety bonds are not as same as corporate bonds and financial guarantees, like we see after maturity of bond we need to pay back. This is not like this. They refer to the performance or delivery obligation to complete the insured object. Corporate bond refer to financial obligation to repay debt or loans that we have seen in earlier cases. Why are surety bonds insurance product introduced for highway contractors? Because the general insurance company will issue the first ever surety bond. So it is from GIC, General Insurance Company, will see the first ever surety bond insurance product for highway contractors. The new mechanism will help boost liquidity in the infrastructure sector by freeing up the working capital in the contractors that they are stuck in the bank guarantee. These funds can be used by contractors to expand business and further boost their infrastructure of the country, and this will help address the challenge associated with highway construction. Now, the current fiscal year witnessed the declining pace of highway construction. The central government may be able to meet only the last year fiscal construction target in financial year 2023, which is lesser than ministry's actual target of 12,000 to 14,000 kilometer. Right now, that is why the surety bonds has been introduced. Now, why SEBI is phasing out the stock exchange route to buy back and how it impacts shareholders. So why SEBI is phasing out the stock exchange route to buyback? Let's first understand. So SEBI prefers repurchase of share or buy companies from shareholders on a proportionate basis through tender offer, and ban the stock market mode, right? And ban the stock market mode when companies buy back it, right? So SEBI is phasing out the stock exchange route to buyback, right? What is the share buyback, share repurchase? When a listed company that is listed in stock exchange, when a listed company buys its own share from existing shareholder, it is known as buyback. It reduces the number of outstanding shares in the open market, which can lead to better valuation and profit earning per share, right? Our earning per share can be increased when companies are holding their own shares, right? The maximum limit of any buyback is 25% or less than aggregate of paid up capital and free reserves of the company. So is there any limit on buyback? Yes, there is a limit which can be 25% or less to the aggregate paid up capital. Now, what is the stock exchange route? How it is being done? A company can buy back shares only on the stock exchange having nationwide trading terminals. The buyback will be made only through the order matching mechanism that promoters or person in control of a company are not allowed to participate. They will not be allowed. The KK Mystery Committee set up by SEBI to found that under the stock exchange route, there is a possibility of one shareholder's entire trade getting matched with the purchase order placed by the company, thus depriving other shareholders from availing the benefit of buyback. That is against the principle of equitable treatment. Maybe one particular customer or one particular shareholder's entire trade is matching with the order that has been given by the company to buy back, so it may violate the principle of equity or equitable treatment. Doesn't benefit smaller shareholders as well, because small shareholders will not have the this liberty to accumulate that much share, right? Now, when we talk about tender route, what is tender route? An offer made by the company to buy back its own share through a letter of offer. Now, it is not through a stock exchange route, it is through tender route. And what is tender route? Own shareholder through a letter of offer from the holders of the share of the company. So, company is directly sending an offer to the shareholder to buyback. It is done on a proportionate basis as per buyback ratio. It is similar to buying shares online through demat account, but it is directly happening with the customer. Now you don't have to go to stock exchange for this reason. The price is fixed and is offered higher than the market price. 15% is reserved for small shareholders also, and democratizes the process, as all shareholders will get to participate. So it is more suitable for, it is giving more equitable opportunity, right? Now, so as we have commodity exchange, stock exchange, we also talk about social stock exchange, that is SSE. SEBI has given nod to National Stock Exchange, that is NSE, for the social stock exchange to set up a social stock exchange as a separate segment of the National Stock Exchange NSE. Now what will happen at social stock exchange, that we need to see. The government had in her union budget speech of 1920 proposed the creation of social stock exchange. It then issued a new security, zero coupon zero principal. Zero coupon zero principal, it is a kind of bond. This year July, SEBI notified rules for SSE. Currently the regulation have prescribed minimum issue size as rupees 1 crore and the minimum application size of subscription at 2 lakh rupees. Subscription to the zero coupon zero principal would be like a philanthropic donation. So it is like, you will not be, zero coupon means you will not be receiving any you will not be receiving any interest, that is zero coupon. You will not receive the entire amount, principal amount that you are contributing, that is for philanthropic donation, that is donation. Means zero principal, you will not be receiving the principal amount as well, so it is donation. As per the SEBI, social stock exchange may be constituted as a separate segment under the existing stock exchange. A social enterprise may be eligible for onboarding on SSE if it demonstrates that social intent and impact are its primary goal and it reports such impact, right? So for social stock exchange, you need to show that your business is giving, or your this enterprise is having some social outcomes as well, and your intent is also the same. This is irrespective of the legal structure of the enterprise. It allows for profit social enterprises as well, right? So it is, and non for profit organization as well. So non for profit as well as for profit with a social purpose to raise funds. So if you are having social purposes, you are contributing in society, so you can have this, right? Examples of SSE, for example, in Singapore, Impact Investment Exchange; Canada, we are having Social Venture Connection; and UK, we are having Social Stock Exchange as well, right? This is this. Now when we talk about application supported by blocked amount system, right? Blocked amount, application supported by blocked amount. The SEBI has released a consultation paper, blocking of funds for trading in secondary market. What is secondary market? When we talk about coming up with IPO, initial public offering, or for that matter FPO, etc., when company is directly selling their shares, their these financial instruments in the market, then it is primary market. When it is getting traded, it is in secondary market, right? So it seeks to extend the ASBA system, ASBA, that is application supported by the blocked amount system, in to the secondary market. Now what is primary and secondary market? As we have already explained you what is primary and secondary. Now what is ASBA in the primary market? When an investor applies to share in an IPO or FPO, follow on public offering or initial public offering, when first time company is selling their shares, it is known as IPO. When second time company is selling their shares, it is known as what? FPO, follow on public offering, right? Deposits a security amount in a separate fund, it remains in the investor's bank account and generate interest, right? So deposits a security amount in a separate fund. When you are when these firms, when they are coming up with IPO or FPO, then they earn interest for the investor, right? If the allotment of share occurs to the investor, then funds are transferred to the company, and if doesn't occur, then the money remains with the investor, then the money is with investor only. This is made possible by ASBA when an investor given authorization to bank to block funds available in her bank account for purchasing IPO or FPO, right? So when you are applying for IPO or FPO, your fund will be blocked. That is known as what? ASBA. Reason behind this move, that ASBA system is primary market, aims to eliminate the need to transfer funds in advance to the broker. Now fund need not to be transferred to the broker, right? What is this entire system is, when you are applying for IPO or FPO, your fund will be blocked in your bank account only. If you have been allotted the share, then the amount will be transferred to the company. If it is not, if you have not been allotted share, your money will remain with you. So earlier the transfer is not required in advance here. Therefore, it reduces the chances of misuse or losses caused by broker defaults. However, currently in the secondary market, investors have to submit collateral or transfer funds in advance to the broker before executing a trade. This sometimes leads to misuse. The Securities and Exchange Board of India statutory, founded in 1988, headquartered in Mumbai, SEBI, right, founded in 1988 but not as a statutory body. In 1992 it got the status of a statutory body. Earlier it was working under Ministry of Finance, right, within the government of India. So this is where we will stop today. This current affairs, we will come up with many more videos, many more topics. So stay tuned to the channel of Victory IAS and see you in the next videos for more updates. Thank you very much. Take care. Bye bye.